Today we break down 3 headlines with big implications for markets and the economy. A massive $36 billion Japanese investment in U.S. energy and critical minerals projects, a projected $150 billion wave of U.S. tax refunds that could flood financial and crypto markets, and a new $85 million settlement from one of America's biggest banks over controversial hiring practices. Japan has announced $36 billion in new U.S. projects, the first tranche of a $550 billion trade and investment pact forged with the Trump administration. Under this deal, structured to deepen U.S.-Japan economic ties, 3 major facilities will be financed by Japanese capital. A $33 billion natural gas plant in Portsmouth, Ohio, set to be the largest in U.S. history, producing 9.2 gigawatts of baseload power. A $2.1 billion deepwater crude oil export terminal off the Texas Gulf Coast, expected to boost U.S. energy export capacity and generate an estimated $20 to $30 billion in annual export value. A $600 million synthetic industrial diamond facility in Georgia, designed to domestically supply a critical material used in industrial manufacturing and semiconductors. Japan's investment comes as part of a larger pact in which the U.S. agreed to reduce certain tariffs on Japanese imports, such as automotives, easing trade tensions and creating incentives for capital deployment. The Ohio gas plant enhances U.S. energy infrastructure, providing affordable baseload power that can help support industrial growth and AI-driven data infrastructure. The Texas oil export facility reinforces U.S. standing as a net energy exporter, which could strengthen the U.S. trade balance and energy independence. The synthetic diamond manufacturing plant addresses shortages in a material critical for advanced manufacturing, reducing reliance on China and helping secure supply chains for technology sectors. This pact underscores a broader effort by the U.S. and Japan to diversify supply chains and reduce dependence on China for key materials and energy. Japan's role isn't just financial, it signals stronger strategic alignment in a fractured global trade landscape. Energy stocks, industrial materials producers, and export-linked companies could see positive sentiment. However, tariff reductions may compress certain import price advantages, requiring careful modeling of sectoral effects. According to Wells Fargo analysts, the U.S. government is preparing to distribute up to $150 billion in tax refunds by late March 2026, the result of boosted refund sizes and tax incentives. The increase in tax refunds stems from recent adjustments in tax legislation and IRS procedures, leading to larger average refunds and earlier distribution. Early IRS data suggests average refunds are up by about 11% this year. Historically, such waves of liquidity have injected fresh retail capital into risk assets, particularly equities and cryptocurrencies, fueling heightened retail trading activity and even speculative YOLO trades. Analysts liken this potential influx to patterns seen in prior stimulus-driven rallies. More disposable income can boost confidence, especially among younger investors who tend to favor digital assets and high-beta equities. Bitcoin and altcoins often benefit disproportionately when retail investors increase speculative buying. Sudden liquidity pours can tighten liquidity conditions in risk assets, compressing spreads and impacting short-term price action. Yet, this isn't guaranteed. Market response will depend on sentiment and broader macro conditions, including rate expectations, inflation data, and regulatory clarity. Wells Fargo has agreed to pay an $85 million settlement to resolve claims it hosted fake job interviews with diverse candidates as part of an internal initiative. A lawsuit alleged the interviews were conducted with no intent to hire, merely to satisfy diversity targets. The litigation stemmed from investor and plaintiff claims that Wells Fargo misled both investors and potential hires by presenting sham interviews, ultimately raising governance and compliance concerns. While relatively small for a major bank, this settlement underscores corporate governance risks. Scandals can damage brand credibility, affect employee morale, and lead to litigation expenses. Investor trust. Shareholders may interpret settlements like this as red flags about corporate oversight and transparency. Banks continue to face scrutiny over diversity initiatives, compliance, and internal controls, even as regulators and markets shift focus to AI, digital finance, and macro policy changes. These 3 developments highlight how global capital flows, domestic liquidity trends, and corporate governance intersect to shape economic and investment landscapes. Japan's $36 billion injection marks a strategic shift in energy and supply chain investment and signals geopolitical cooperation with economic consequences. A projected $150 billion tax refund wave could fuel risk asset inflows, particularly crypto and equities, if sentiment responds. The Wells Fargo settlement reinforces plain governance risk themes which investors must weigh beyond earnings and charts. If you found this detailed analysis useful, Subscribe and hit the notification bell for more market breakdowns and investing insights.